Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about an exceptionally interesting area of the market for those of you who are money managers, etc. We're talking with someone who has a massive amount of experience running an OCIO, Chris Vella, CFA. He is the Chief Investment Officer of BNY Advisors. Previously, he held a similar role with Northern Trust Asset Management, where he served as Chief Investment Officer of Multi-Manager Solutions. Chris earned his undergraduate degree from Lehigh University, and as I said, he is a CFA charter holder. So welcome to the podcast, Chris.
Thank you. Great to be here, Rob.
So first up, I would like you to just give us a little bit of the waterfront of what BNY Advisors does, because OCIO is a very simple phrase that means a lot of different things.
Yeah.
So let's just clear that first.
Absolutely. Thank you. So great to be here. The BNY Advisors manages about $200 billion in assets for clients across institutional and intermediary space. On the institutional side, it's primarily outsourced CIO, OCIO, for defined benefit, foundations, endowments, family offices. And on the intermediary side, we pair up with RIAs, broker-dealers, banks, trust departments as well to help them build out their entire investment platform. We've got about 80 professionals, a little bit more than that, dedicated to the business overall. And really, I like to think of it as an extension of staff, where we go to our clients, whether institutional or private wealth, and are able to give them kind of the best and brightest ideas from BNY.
Okay. And are there functional things you don't do? You know, when OCIO started, they did basically everything, right? So from tax prep to all other kinds of things. Are there things that you all focus on, do less of, do more of, et cetera?
Yeah, so we obviously are a large financial institution where we can literally take on just about everything another institution is doing today. So there are few things that we cannot do, frankly. So we are set up as well to provide these services across everything from investments asset allocation to direct investments into money managers and strategies, private markets, et cetera, and also take on services like treasury services, cash management, custody, so asset servicing. So we're really able to become a strategic partner for a lot of our clients and build off of what might be one or two things they're interested in to really have a full gamut of solutions for the client overall.
Yeah, I mean, it's an excellent place from a business to be because you don't know when interest rates are going to rise and all of a sudden cash management is going to be important again.
Absolutely. Absolutely.
Things change.
That's right.
You have a lot more experience than most people in this role. So I just was going to ask you one of those questions that you ask someone with a lot of experience is, how do you see the OCIO business evolving from here? It's been through a lot in the last 15 years, so how do you see it get from here?
It has. And I remember starting out in what wasn't even called OCIO at the time, 30 plus years ago. And
was it called multifamily office?
It was. There were different names for it, but the idea though is that now everyone seems to be in this business, and they're in the business for a reason, right? There are so many, whether it's a financial institution or it's a consulting organization, they're looking at ways that they can help their own clients, and that's really the goal. And I think that OCIOs, as they develop from here, it becomes much more global in nature. I think the outsourcing trend will not stop. I think it'll only progress even further. We've seen that kind of infiltrate into the foundation endowment space. I think you'll see it more and more on the family office space as well. And I think it'll just expand over time. It'll expand in different ways, though. I mean, and it's important that, at least the way I think about it and the way we're set up at BNY, we don't need to be everything to everyone. If we're set up the right way, we can really help our clients in certain areas where they need the most help. So if they really need support on the asset allocation side, we can just provide that service. If they really need support in manager research on the traditional side, we can do that. So I think that's important, and that's where I think you'll see a lot of our peers moving in the same direction, being able to offer a lot of services, a lot of different areas, but being very flexible with their clients to offer different things to different people.
Yeah, I mean, there are all these trends that are supporting some of those things too. If you look at the relative expense of running a single family office, for instance, you have to have a lot of assets under advisement to even come close to rationalizing a single family.
And that's a great point, Rob. And I think that it's an area where the largest institutions have quite a big advantage. So you're able to say, we'll take the custody, the admin, and the investment side and be able to do all of this for you. And any one of those verticals is going to be cheaper than you can go anywhere else. So you can really reduce the overall expenses for a lot of clients.
Right. I mean, and this is also, the decline in expenses, et cetera, has also affected something else I think is interesting to shift to the asset side for a second. I'm talking about alternatives. Over the last 20 years, we've seen a massive decline, not only in the minimums required for them, as sort of legal statutory stuff, but also lower fees, which, occasionally they jump up again, but they're generally going down. So when you're working with your clients on, and this is the thing I think is exceptionally interesting from the manager search and selection process, when you're working with your clients on portfolio construction of alternatives, how do you view all those trends? And, I realize there's a question of what the client needs. Let's leave that to the side for a second and just talk about it in general.
Yeah. So, love the discussion around alternatives. It is obviously the hot topic these days right now in the markets. And a lot of that is all about product development and just advances we've seen in the markets around product development for a broad landscape of what's called quote unquote alternatives. Reality is that private markets and access exposure to private markets is being driven down to the common man, everybody, right? Everyone will be able to have the capabilities of getting into a 1099 version that's a public-private strategy. So access to private markets is really, truly expanding. The opportunity set is really growing pretty tremendously, and it's happening right now. I mean, it's been going on for the past few years. It's really taking hold today. So a couple of really key trends that we're seeing in the market, one of the important ones are these strategic partnerships. It's something that BNY is doing a lot of. We're very actively discussing with a lot of our peers around, we keep going back to we can't be, the solution for everyone in every single category, but we can find and identify some really some strength in the marketplace, whether it's private equity, private credit, or other areas, and create public-private solutions for clients across the board. And we're seeing that in the industry. And you're seeing that across the board. So you're seeing that you've got public-private solutions in interval fund structures available for model portfolio management and somebody who might have $50,000 to invest, which is really incredible. Ultimately, what's the point of doing that? It's not just to, grow a certain competitor that's really good in the alternative space, let's say, without naming names.
Right.
But it's to create resilient portfolios from an asset allocator and someone who cares about risk management and diversified portfolios. In order for us and the ability for us to have exposure to different parts of the private credit market, different parts of the private equity market, infrastructure, real assets, having these products and strategies is really important for allocators.
I mean, ultimately, to put this into CFA terms, because we have to do that every once in a while, it's diversification. Right? That's right. It's actually lower risk at a similar rate of return.
Exactly.
Right. So, and we just glazed over a lot of subcategories there real quick when I said alternatives. Do you think that any of them offers a better exchange of risk versus return right now based on their setup? I know you just mentioned private credit. Boy, there's a lot of money going into private credit.
A lot of money going into private credit.
Are there other ones that you think are, that don't quite get the attention they should?
Yeah, it's a great question. I think the private equity side of the equation, there has been a lot of money in private equity. There has been less money on at least from the retail space and the private markets in that category. I think there's definitely opportunity within venture, within growth in the private equity space that's still pretty attractive right now. It also gives you access to, when you think about the overall public markets, public U.S. small cap, you almost see private equity as a substitute for U.S. small cap in a lot of ways. I'm probably upsetting a lot of people out there, but I think there's a really interesting swap there going on in the markets today, and it gives you access to parts of that market, particularly technology, biotech, other areas that are just really hard to find in the public space or impossible to find in the public space. So if you want companies that are single players in the AI space or in certain areas of virtual coins and things like that, that's where you're going to find the most attractive opportunities in private equity. Private credit is a crowded space. There's no doubt about it. But you're seeing some of the same dynamics, right? Banks exiting parts of the credit market overall, and private players kind of stepping into that. You're also seeing some much more attractive liquidity profiles for private credit when you think about Again, moving down market in terms of wealth management opportunities. The duration is not the same duration that you're thinking about for private equity space. The cost is not the same as well. So I think there still are interesting opportunities there. And the private credit arena and that asset class is stepping into a void in the markets to a large degree.
Right after the bank regulation came on and non-banking financial institutions came around, it was sort of logical if you think about it from that perspective. But over all of this is an exceptionally difficult due diligence task, right? Because as you have more and more of these things, there are different risks that rise amongst them. So can you zoom in on how you do that? How
Yeah, love that question. So because I spent 30 years pretty much looking at manager research, looking at managers, evaluating managers.
I thought you would like that.
Right, exactly. So thank you for that. If you look at the opportunity to outperform consistently, and also if you look at the bottom tier of some of these private market players, there's a lot of consistency in the bottom tier as well. So manager selection and selecting highly skilled managers in that private market arena, again, that's a broad brush, but across the board, whether it's private equity, private credit, you see a lot more opportunity to outperform. You see a lot more opportunity to outperform by a significant amount. So that selection is a big deal. It's really important. The investment due diligence is critical. There's a lot of information still to this day that is difficult to attain, difficult to get your hands on. And the ability for someone who has 15, 20 years of looking at different investment strategies within the venture space is by far a huge advantage compared to someone who may just be starting in their career. And it just takes experience. So there's the skill set of identifying other people's skill. There's the risk management part of this. But importantly, that gets overlooked sometimes in private markets, the ODD side of this, the operational and compliance due diligence, is very important. If in those instances where we see issues around compliance or operations, we're stepping away. We really there are enough good players out there for us to invest in. We really don't want to take that kind of risk, and that ODD becomes that much more important when there are organizations and firms not registered with the SEC potentially who don't have as much transparency around some of the history and the background of their personnel. So the background checks and everything we're doing on the ODD side is really important.
Right, but you're sort of downplaying there. A lot of it is just experience at knowing the players for a long time.
Huge. That's a big advantage for those who've been in this for a long time. Absolutely.
Yeah, I think that is exceptionally difficult in a day and age where we're talking about the innovation of AI, et cetera. It kind of can't beat knowing who to work with and who not to work with, right?
Well, the ability to get in, right? It's one thing for AI to tell you to get to something, but the ability to actually get in when a family office is new and may not have the experience of investing in Fund 9, Fund 10, and Fund 11 comes around, to have the opportunity to get into that fund can be difficult or restrictive.
Right. So shifting a little bit to the client side, this trend in alternative investments also makes me wonder about one thing. So most people there's been talk about 401ks being able to invest in different types of alternatives, mostly private credit. A lot of clients are accustomed to daily liquidity with all of their investments. It can be a big jump to the impact of, say, vintages on private equity, or when the markets freeze as they did. The most of the high yield market froze solid back in March. So for a short period of time, but it reminded us that there's not always liquidity in those things. Do you think clients are ready for that?
Education is huge, and it will be so important for the acceptance and the true broadening out of these asset classes. So if placing private market exposures in client portfolios without the proper education will be disastrous. So that's really important. So making sure clients really understand liquidity profile of what they're getting into, and understand the quarterly redemption cycle that takes place. They'll take your money every single month, but they may not give it back unless it's at the quarter end. That's also a different way to. But I will say, on the positive side of that coin, is that there are going back to the product development within alternatives. There are some important instances here where we are moving and pushing the envelope towards daily pricing, so that we have daily pricing in some of these vehicles. Interval strategies that will provide daily liquidity is also available, especially when you go back to a public-private, not a pure private play. So you're getting into the space of really this acceptance and ability for investors, all investors, to be able to invest. When the doors shut down, even in the interval funds, there are ways to shut down liquidity or limit liquidity. Shut down, limit liquidity, and that again will be a big educational, important educational piece for us to, as an industry, to make sure clients really understand what they're getting into.
Right. That's kind of what I was trying to underscore there.
Yeah.
Is it would be great if some of the GPs could wiggle a little bit.
That's right. But I also think that this will most likely create this dichotomy in the marketplace as well. So I think the K1s will continue. I think there will continue to be some advantage to having locked up illiquid strategies as well. And there are going to be strategies that just will not adapt or be able to adapt to the daily pricing environment of what a liquid strategy needs to provide. So I think you'll end up with this situation where we are already, to some degree, investors who are higher net worth investors' ability to access and have that quarterly liquidity lockup with a 10-year window, and basically investors who will not have access to that.
So what does that look like? Is it venture mainly, or is it some private equity?
A lot of private equity will be in that category. I think there'll be special situations in that category as well. I think that private credit likely not so much. I don't think they'll really ever need to be in that category. That you'll probably see a complete switch over into just more liquid environments for a lot of private credit.
Okay, great. Well, so thank you, Chris. That was an exceptionally interesting walk down the OCIO path. I'd like to remind anyone who is a member, if you like what Chris was saying and you're a member of CFA Society New York, you can watch his video on some of these comments, et cetera, from the event that we had last month when he was on a panel. If you're not a member, please join us. Before we sign off, dear listeners, I have some things I need to tell you. So this is my last Compound Insights podcast. I will retire soon. I want you to know that Compound Insights will go forward in the able hands of Gary Farber, and its educational goal will continue too. So please don't unsubscribe. Please stick around, and we might have a little bit of things to do as we change the infrastructure here, but give us a couple weeks. I also wanted to say thank you all for listening. Compound Insights is my magnum opus here at CFA Society New York, but it is not mine alone. Chris Brzeze, a person who would rather not be in front of the microphone, was more than our audio expert during these years. He helped guide it since we started it back in 2019. So after 164 episodes, that is 54 and a half hours of content. Thank you for listening. And for the last time, this is Compound Insights, and I was your host, Rob Rowan. Goodbye.